every hour of every single day. Inside an anonymous-looking government building in Washington, D.C., machines roar like industrial beasts as they slice, stamp, and press ordinary sheets of cotton paper into something far more powerful than gold: United States currency. These printing presses do not sleep. They run 24 hours a day, 7 days a week, spitting out more than $500 million daily. To the average person, that already sounds unbelievable. But here's the twist almost nobody understands. What those machines produce is only a fraction, an unbelievably tiny fraction of how much money actually comes into existence. The real money, the money that actually inflates your rent, the money that makes groceries more expensive, the money that quietly pushes you into debt every single year, is never printed at all. It is typed, literally typed, created inside a computer by people you will never meet, and institutions you will never vote for. Every day, over $4 billion appears in the US financial system out of thin air. It has no physical form, no ink, no paper, no vault, no limit. Yet it controls everything from mortgage rates to credit card debt, to whether your paycheck can actually buy what it could last year. Most people think they understand money because they use it every day. But most people don't realize that the money they were using passed through dozens of hands before it ever arrived in their bank account. It was created, borrowed, loaned, leveraged, and multiplied long before you ever touched it. A single dollar often begins its life as nothing more than a digital entry typed into existence by a bank, employee, a central banker, or a government computer. But this wasn't always the case. In fact, to understand how unstable the modern system really is, we have to rewind thousands of years to a time when money didn't exist at all. Imagine you're living in a small farming village long before anyone invented currency. If you needed a new tool, you couldn't go to the store, you couldn't swipe a card, and you definitely couldn't take out a loan. You went to the local tool maker, and if you had nothing to trade, you made a promise, literally a verbal IOU. Back then, money wasn't pieces of paper or numbers on a screen. It was trust. Your word was the currency, and because the tool maker trusted you, that invisible promise had value. This simple system worked until villages grew into towns and towns grew into cities. Suddenly, promises weren't enough, so people began trading things everyone needed: grain, salt, cattle. These items became early forms of money because they were valuable, difficult to produce, and essential for survival. Yet even those forms of money couldn't keep up with humanity's appetite for trade. So metals arrived: silver, gold, small, durable, easy to transport. The moment society adopted gold coins, global trade exploded. Goods moved across continents, wealth traveled from empire to empire. And for the first time in human history, people could accumulate and store value in a little metal disc. But gold came with a problem that would eventually reshape civilization. Gold was heavy, risky to transport, and easy to steal. And that is where everything changed. Because the moment people got tired of carrying heavy bags of gold, they started trusting someone else to hold it for them. And that trust, misplaced or not, became the spark that led to the modern financial system. But here is the part almost no one hears in school. This system, built hundreds of years ago, was not designed to be fair. It was not designed to be stable. It was designed to grow endlessly, no matter how much debt it created, and no matter how much purchasing power it stole from everyday people. That same system is still running today. Only now it's supercharged by computers and digitized beyond recognition. Before we continue, let me know where you're watching from in the comments. I love seeing this community grow across the world. And if you want more deep dives into the hidden mechanics of money, tap subscribe, because what you're about to learn will change the way you see every dollar in your wallet. To understand the madness of the modern financial system, we have to go back to the moment when gold itself stopped being enough. By the 17th century, cities were bursting with trade. Merchants were traveling across continents, and kingdoms were competing for global influence. Commerce was accelerating faster than at any other time in history, and the world needed a faster way to move money. Gold was valuable, but it was also bulky, heavy, and dangerous to carry. A wealthy merchant could easily lose everything to a single bandit on a dark road. In London, something revolutionary began to happen. Wealthy citizens started leaving their gold with trusted goldsmiths, because goldsmiths already had vaults and guards to protect their raw materials. In exchange for storing gold, the goldsmiths issued paper receipts, small handwritten notes, promising that the bearer could redeem the exact amount of gold at any time. These notes had no value on their own. They were just paper. But people began to realize something remarkable. If everyone trusted the goldsmith, then trading the paper note was just as good as trading the gold itself. And so the world's first paper money emerged, not created by kings or governments, but by private businessmen running what were essentially early banks. Merchants began exchanging these receipts with one another instead of using physical gold. The receipts were lighter, safer, and universally trusted across cities. But once again, trust opened the door to temptation. Goldsmiths noticed that people rarely came to collect their gold. Days, weeks, months would pass, and the gold in their vaults barely moved. So they asked themselves a question that still defines our financial system today. If no one is coming to get their gold, why not loan out some of it? At first, they loaned only the gold that actually existed. But eventually they took the next step, the step that changed everything. They started issuing receipts for gold that wasn't there. A farmer might come asking for a loan, and instead of handing him real gold, the goldsmith simply wrote a new receipt of promise for gold that didn't exist. That receipt instantly became spendable money. The farmer would use it to pay a toolmaker. The toolmaker would use it to buy goods. Those goods would circulate across the local economy. And with each transaction, real economic activity was happening. Yet none of it was backed by new gold. The goldsmith was no poorer. The vault still held the same amount of gold, but the economy suddenly had more money in it, money that existed only on paper. For the first time in recorded history, wealth was being created from nothing. It was pure financial alchemy. Every time a goldsmith wrote a new promise note, he created brand new money that didn't previously exist. But the dangerous brilliance of this system was the illusion. As long as people trusted those notes and as long as they didn't all try to redeem them at once, the system functioned perfectly. But if too many people demanded their gold at the same time, the whole operation collapsed. This was the birth of what we now call a bank run, a phenomenon that still haunts modern markets. Fast forward to today, and the transformation is complete. The goldsmiths evolved into commercial banks. The promised notes evolved into digital entries in your bank account, and the gold disappeared entirely. Modern banks no longer need physical reserves to match their loans. When you walk into a bank and borrow $20,000, they don't open a vault or move cash from one drawer to another. They simply type the number 20,000 into your account. That keystroke, nothing more, is how most money on earth is created. This digital money then enters the real world. You buy a car with it. The car dealership pays its employees. Those employees buy groceries. The grocery stores pay suppliers. And just like that, from a single keystroke, hundreds of transactions ripple through the economy. New jobs are supported. New products are created, and new wealth appears to exist until it doesn't. Because the flaw in the system remains exactly the same as it was in the 17th century. The money is never truly created. It is borrowed. It comes into existence as debt and disappears when the debt is repaid. And this structure sets the stage for the problems society faces today. The more money banks create, the more debt society must carry. But the more debt society carries, the more money must be created to keep the system running. It is a cycle that feeds on itself, pushes prices upward, and requires endless expansion to survive. This is where inflation, inequality, and financial instability begin, not at the printing presses in Washington, but inside the digital heartbeat of the banking system itself. The uncomfortable truth is that the vast majority of dollars floating around the economy were never printed. They were promised, created, loaned, and multiplied by keystrokes. And the people operating those keystrokes have more control over your financial future than any politician ever will. As lending became more sophisticated and banks expanded their power, society entered a strange new era, one where money no longer behaved like a physical object, but like an idea that could be inflated, stretched, and multiplied without limit. To understand how this shift turned into the financial system we live under today, imagine the economy as a small village for people who collectively possess only $100. No matter what they buy or sell, the total amount of money never changes. It simply moves from one person to another. If one villager becomes wealthy, someone else must become poorer. Wealth in that kind of system is a zero-sum game. But once banks started creating money through loans, something revolutionary occurred. When a bank issued a loan by typing new numbers into an account, it didn't simply redistribute existing money. It created entirely new purchasing power out of thin air, increasing the total amount of money in circulation. Suddenly, wealth no longer required someone else's loss. The pie didn't have to be cut differently, the pie itself could grow. This expansion of the money supply meant people could start businesses that didn't exist before. Farms could buy better tools. Blacksmiths could hire apprentices. Builders could build homes instead of waiting for rare, slow-moving gold coins to trickle through the community. Productivity surged, innovation accelerated, and civilization took a massive leap forward. But as the system grew, so did its complexity. Money wasn't just changing hands, it was multiplying. A single loan didn't simply benefit the borrower. It cascaded through society, bouncing from person to person. becoming the foundation for hundreds of additional exchanges. Someone who received the borrower's money might deposit it into their own bank. That bank could then use the deposit as the basis for issuing more loans. Those loans would be spent, redeposited, and lent out again. This was the beginning of what economists call fractional reserve banking, although today most banks barely have any reserves at all. In the old days, banks were required to keep some cash on hand to handle withdrawals. But in modern finance, banks can create loan after loan with virtually no limit, as long as they maintain a positive relationship with the central bank. If they run low on cash, they simply borrow more from the central bank, which itself has the power to create money in even larger quantities. Here is where the illusion becomes dangerous. Even though banks appear to be lending money they possess, the majority of the money they lend has no physical form. It exists only as a digital entry. And when borrowers repay their loans, that digital money vanishes from the system, leaving behind only the interest owed. This means the economy always needs more money than currently exists in order to pay back the combined principal and interest on all outstanding loans. In other words, the financial system must constantly expand. If money creation stops, the economy slows. If the economy slows too much, businesses fail, unemployment rises, people default on loans, and the entire structure begins to collapse. To avoid collapse, new money must be pumped into the system continuously. This relentless need for expansion is why the question, where does money come from, is so important and so misunderstood. Most people imagine a printing press spitting out dollar bills, but that's only a small piece. The real engine behind money creation is debt. Every loan adds money to the economy. Every repayment destroys money. Because banks want profit, they are motivated to issue more loans. And because society relies on the money created by those loans, we become trapped in a cycle where debt is not a side effect of the system, it is the system. This is why inflation emerges as soon as the supply of money grows faster than the supply of goods. If you increase the number of dollars in circulation without increasing the number of things to buy, each dollar loses some of its purchasing power. Prices rise because more money is competing for the same goods. It is not a conspiracy or a fluke. It is the mathematical result of money creation. And since banks create money far more rapidly than society creates new products, inflation becomes an ongoing feature of modern life. You are living inside a machine that must produce debt to stay alive. Every mortgage, every car loan, every credit card swipe, every government spending bill, every corporate line of credit is another pulse of new money entering the system. Without that constant flow, the economy would stall in the same way your heart would stop without fresh blood. And now we arrive at a critical point in understanding the financial world. If money is created through debt, then someone must always owe. In other words, for money to exist, society must remain in permanent debt. The system can never be fully paid off. It was designed that way. To truly understand how money is created today, we have to zoom out from the individual bank and look at the entire financial ecosystem, especially the central bank. Most people picture the Federal Reserve as a kind of giant vault or a government agency that stores cash. But the truth is far stranger. The Fed is more like a money manufacturing engine that runs on debt and government promises. It can summon billions or trillions of dollars into existence without printing a single physical bill. And it does this through a process built on government bonds. A government bond sounds complicated, but at its core, it's simply an IOU. When the US government needs money, usually far more than it collects from taxes, it creates these IOUs and sells them to investors. Banks, corporations, foreign governments, and even everyday Americans. Buyers hand over real dollars in exchange for a promise that the government will pay them back over time with interest. This influx of borrowed money flows straight into the government's budget. It funds everything, from highways to hospitals to military jets and social security checks. The money spreads through society as salaries, contracts, and benefits, eventually landing in bank accounts across the country. But here is the twist. The government almost always spends more than it earns. And the gap between spending and tax revenue must be filled by issuing even more bonds. Those bonds accumulate into a mountain of national debt, and the interest paid on that debt becomes one of the largest expenses in the entire federal budget, bigger than many government agencies combined. As the debt rises, so does the need to issue more bonds, trapping the government in a cycle where borrowing becomes permanent. Banks play a critical role here because when the government spends this borrowed money, it flows back into the banking system. Banks receive deposits, and deposits allow them to issue even more loans. Every new loan becomes new money, but banks rely on the central bank to provide the base layer of money, the foundational cash that ensures the system doesn't run dry. This is where the Federal Reserve steps in with powers that seem almost magical. If a bank runs low on reserves, the cash it needs to legally back its loans, it can simply request more from the Fed. The Fed does not dig into a vault or collect taxpayer money. Instead, it types numbers into existence. With a few keystrokes, the central bank deposits newly created money into the banking system, allowing banks to continue lending and expanding the economy. No gold is melted, no printing press is needed. It all takes place digitally, invisibly, and instantly. But the most astonishing part of the process happens when the central bank purchases government bonds. When the Fed buys a bond, it does not pay with existing money. It simply creates new money out of thin air and uses it to buy the bond. The seller, often a large bank, suddenly has fresh cash sitting in their account. This new money flows out into the economy, increasing the amount of dollars in circulation. The bond, meanwhile, becomes an asset on the Fed's balance sheet. This practice, called open market operations, is the central mechanism by which modern economies expand their money supply. This system is elegant on the surface, yet deeply unstable underneath. The government relies on bonds to keep operating. Banks rely on the Fed to supply reserves. And society relies on banks to create enough money through loans to keep the economy growing. The problem is that when money is created faster than real goods or services, inflation rises, prices climb, and everyday people feel poorer even though their salaries might stay the same. The dollar loses value gradually, not because of natural forces, but because the money supply keeps expanding while productivity struggles to keep up. Meanwhile, the government's hunger for money grows every year. Last year alone, the United States government spent nearly $7 trillion, but taxpayers did not provide anywhere close to that amount. The difference had to be borrowed, creating new debt that future taxpayers will eventually pay. And when even that isn't enough, the central bank steps in and creates new money to support the system, money backed not by gold or resources, but by the government's promise to pay tomorrow for what it spends today. This cycle: government issues bonds, banks buy bonds, the Fed supports banks, and society runs on newly created money, is the engine of the global financial system. It keeps economies growing, but it also keeps inflation alive, national debts expanding, and the value of money quietly eroding over time. To understand why your dollar buys less every year, you have to understand one uncomfortable truth. Inflation is not an accident. It is not a glitch in the system. Inflation is the system. It is built into the DNA of the modern economy because money is created far faster than actual goods and services can be produced. Once you recognize this, the rising prices at the grocery store or gas pump stop looking random and start looking inevitable. Inflation begins the moment new money enters circulation. When banks issue loans, even though the money never existed before, those digital dollars immediately become part of the economy. They chase real products like cars, homes, and food. If there are more dollars than things to buy, prices naturally rise. And because every new loan creates brand new money, the money supply grows relentlessly. Your paycheck does not, your savings do not, but the supply of dollars does. This is why inflation is often described as a silent tax, one you never vote for and never notice until it's already eaten into your wallet. Consider how the economy used to work when money was harder to create. Before the system of digital loans, people used real commodities, grain, cattle, salt, and eventually gold to store value. You could not magically create more gold with a keystroke. It had to be mined, hauled, refined, and certified. That natural limitation kept the money supply stable. But once banks discovered they could loan out money that did not exist, the entire economy changed. Suddenly, the amount of money in circulation was no longer tied to anything physical. It was tied to human decisions made by bankers, central banks, and governments. Now imagine an economy with a fixed amount of money, as in the farmer and toolmaker example. Money simply moves around from person to person, but that system breaks down quickly in the real world because wealth becomes concentrated. One person who wins the economic game ends up with most of the money, leaving everyone else with too little to participate. Spending slows, businesses fail, unemployment rises. It becomes a deflationary death spiral because money stops circulating. This is why modern economies constantly inject new money into the system. New money keeps things moving. It keeps businesses hiring, consumers spending, and innovation growing. But injecting money is not a neutral act. It comes with consequences. When the amount of money increases faster than the amount of real stuff, food, homes, cars, technology, prices must rise. It's simple: supply and demand, more dollars, same amount of goods, higher prices. This process has been slow and mostly contained for decades because productivity in the US was rising at the same time. But in the last 20 years, productivity has stalled while money creation has exploded. Banks have issued more loans, governments have issued more bonds, and central banks have printed more digital reserves than ever before. In 2020 alone, the United States created over 25% of all dollars in existence. That single year permanently reshaped the financial system and flooded the country with money. That had no relationship to increased productivity. The result was predictable. Housing prices skyrocketed, car prices rose, food costs soared, wages lagged far behind. The average person felt squeezed even though the economy, on paper, appeared to be growing. That contradiction, growth without well-being, is the hallmark of an inflation-driven economy. The effects go deeper. When inflation rises, it erodes savings. A person who diligently saves $10,000 loses purchasing power every single year, unless their savings grow faster than inflation. In a low-inflation world, that was manageable. Today, it is not. Inflation punishes savers and rewards borrowers because debt becomes easier to pay off over time. With devalued dollars, this creates a culture where debt is not just normal, it's necessary. People borrow for cars, for homes, for school, for emergencies, because the system itself nudges them toward debt. The dollar today will buy more than the dollar tomorrow, so spending feels rational and saving feels pointless. Governments also benefit from inflation because it reduces the real value of their debt. $1 trillion borrowed today is cheaper to repay tomorrow if each dollar is worth less. This creates an incentive, whether admitted or not, for governments to tolerate or even encourage moderate inflation. It is a slow erosion of value that affects every person in the economy, if you understand why it happens or who benefits. And then there's the most powerful inflation driver of all, central banks. When the Federal Reserve decides to stimulate the economy, it creates new money digitally and pushes it into the banking system. That money flows into financial markets, into mortgages, into corporate debt, into government spending. The Fed's balance sheet reveals the truth: trillions of dollars created out of nothing, pushing asset prices higher while wages struggle to keep up. This is why inflation is rising even when people feel like they're working harder than ever. The system is designed to create money faster than the economy can grow. And as long as that remains true, inflation will remain part of your life whether you like it or not. The modern banking system is built on a truth so strange and counterintuitive that most people never believe it the first time they hear it. Banks do not lend out the money you deposit. When you place $100 into your bank account, the bank does not store it somewhere in a vault waiting for you to withdraw it. Instead, the bank records that it owes you $100. That number on your banking app is not a pile of cash with your name on it, it is a promise. Nothing more. The bank becomes indebted to you, not because your money is locked away, but because they have a legal obligation to give you that amount when you ask for it. When a bank issues a loan, the reverse happens. You do not receive money someone else deposited. You receive brand new money that didn't exist 5 seconds earlier. The bank simply types the number into your account, and now the economy has more money than before. This is the moment where the money supply expands. It is the digital equivalent of the goldsmiths writing promises on paper and circulating them as if they were real gold. The loan becomes an IOU, and once the borrower spends that money, it enters the bloodstream of the economy, moving from person to person, business to business, creating economic activity that would not have existed without it. This is why loans are powerful. They fuel home purchases, car sales, business expansions, and technological innovation. A single mortgage loan can create a chain reaction of economic activity: construction jobs, real estate commissions, appliance purchases, furniture sales, and transportation cost. All of this begins with money that was never in the system until the bank created it. The moment the loan is spent, the money becomes part of the broader economy, but the original debt remains attached to the borrower until it is repaid. Yet this system creates a paradox. When a loan is paid back, the money that was created disappears from the money supply, but the bank keeps the interest as profit. This means banks have a built-in incentive to continually issue new loans, so that more money enters the system, because without constant credit creation, the money supply would actually shrink, causing deflation. And deflation is the nightmare of modern economies. Falling prices sound good in theory, but they lead to falling wages, failing businesses, and widespread economic collapse. So the system pushes toward expansion by design, not because of greed, but because the alternative is catastrophic. The real twist comes when banks run low on reserves. In the past, banks could not issue loans beyond a fraction of the money they physically had. Today, however, the Federal Reserve serves as the ultimate backstop. If a bank needs more reserves, they request them from the central bank, which can create them digitally with a keystroke. It is another layer of money creation, even more abstract than the bank's own lending. As long as the banking system remains functional, and the Federal Reserve is willing to provide liquidity, there is almost no limit to how much new money banks can generate through lending. But even this is only half of the story. The US government itself creates one of the largest streams of new money, not through printing dollars, but through issuing treasury bonds. A government bond is simply a promise. Lend us $1,000 now, and we'll pay you back with interest. When banks, corporations, or foreign countries buy these bonds, they give money to the US government, which then spends that money back into the economy on salaries, construction projects, military contracts, and social programs. The government rarely earns as much money as it spends through taxes, so every year it issues more bonds to cover the difference. Those bonds are purchased using real money, but the spending they enable injects brand new money into the economy. This process becomes even more dramatic when the Federal Reserve buys government bonds. When the Fed purchases a treasury bond, it creates new digital money out of thin air and uses it to buy the bond from a bank. The bank now has more money to lend. The government has more money to spend, and the money supply grows once again. This mechanism known as quantitative easing has created trillions of dollars in the last decade, pushing stock prices higher, real estate values up, and everyday consumer prices to levels that shock the average person. All of this brings us to the core insight. Today's money system is not built on physical goods or finite resources. It is built on trust, debt, and perpetual expansion. Banks create money when they lend. The government injects money when it spends beyond its revenue. The central bank reinforces the entire structure by ensuring there is always enough liquidity to keep the machine running. It is a system that rewards borrowing, discourages saving, and makes inflation a permanent feature of modern life. Government debt is often talked about like a household budget problem. Politicians say things like we need to stop spending more than we earn, or the government needs to live within its means. But the truth is that government debt operates on a completely different set of rules that most people never learn and that almost no average citizen understands. The US government does not run out of money the way a family would, because the US government is the entity that creates the money in the first place. And the primary tool it uses to do this is the US Treasury bond. A treasury bond is deceptively simple. It is a promise. Lend us money today, and we'll pay you back with interest later. To most people, a bond sounds like debt, almost like borrowing from a credit card. But to the US government, issuing a bond is more like opening a valve in the financial system. When the government creates a bond, banks, pension funds, wealthy investors, and foreign nations buy it. Trillions of dollars flow into these bonds because they are considered one of the safest investments in the world. And the instant someone buys that bond, the US Treasury receives brand new money to spend money that did not exist inside the government's accounts the day before. This is the moment where government debt becomes government-created money. When the US spends this bond money, whether on public workers, military contracts, infrastructure projects, or social programs, that money enters the economy and circulates through businesses and households. The construction worker who builds a highway gets paid. The company that supplies materials earns revenue. The local grocery store profits from the workers spending their paychecks. The ripple effect is enormous. In this way, government spending injects brand new liquidity into the bloodstream of the entire economy. But here is where the loop becomes strange. The US government almost always spends more than it collects in taxes. This means it must issue even more bonds to cover the difference, and that leads to more money entering the economy. Taxes do not fund the government the way most people imagine. Taxes primarily serve to remove a portion of the money supply, to keep inflation from spiraling out of control, and to give the dollar its value through legally enforced demand. The government creates money through spending and destroys some of it through taxation. But the overall trajectory is always the same: more money entering the system every year. To keep this machine running smoothly, something else has to happen behind the scenes. Banks and investors must want US bonds. As long as people and institutions trust the US government to pay its debts, the cycle remains stable. But if demand for these bonds weakens, interest rates rise, borrowing becomes more expensive, and the government must spend even more money just to service its past debt. This is why interest payments are now one of the largest expenses in the federal budget. The government isn't getting crushed because it can borrow, it's getting crushed because the cost of borrowing keeps rising. The Federal Reserve plays an even more surreal role in the system. When the Fed wants to stimulate the economy, it buys treasury bonds from banks using brand new digital dollars. These dollars did not come from taxpayers. They did not come from savings. They were created on a computer screen at the moment the Fed made the purchase. This is how trillions of dollars enter the economy during financial crises and recessions. This process, quantitative easing, floods banks with new money, lowers interest rates, and pushes investors toward riskier assets like stocks and real estate. It is one of the reasons asset prices have exploded over the last decade while wages have barely moved. The system is built on continuous expansion. If the government stopped issuing debt tomorrow, the economy would seize up like an engine without oil. Businesses would lose contracts, households would lose wages, banks would lose liquidity, and the entire global financial market would be thrown into chaos. US debt is not just a number, it is the foundation of world finance. Foreign nations use US bonds as collateral, savings vehicles, and financial anchors for their own currencies. If the US stopped issuing debt, the world economy would lose its reference point, and global trade would destabilize overnight. This is why the system cannot stop. The United States must continue issuing debt, because its debt is the backbone of global confidence in the dollar. And as long as the world trusts that the US will not default, the US can continue bringing new money into existence. By issuing more bonds, selling them, and spending the proceeds, it is a delicate balance. The government must maintain trust, manage inflation, and keep interest rates under control, all while sustaining a system that relies on perpetual debt to function. At this point, it should be clear that money is constantly being created through loans, government debt, and central bank intervention. On the surface, this sounds like a good thing. More money should mean more prosperity, more opportunity, and a higher standard of living for everyone. But this is where the system reveals its most uncomfortable truth. Creating money does not automatically create real wealth. And when money grows faster than productivity, the result is inflation. Inflation is often explained as prices going up, but that description hides what is really happening. Inflation is the gradual loss of purchasing power. It is the silent process through which your money buys less tomorrow than it does today. If your paycheck stays the same but prices rise, you are effectively getting poorer even though the number in your bank account has not changed. This is why inflation feels so personal. You don't see it on a chart first. You feel it at the grocery store, at the gas pump, and when rent goes up for the third year in a row. The key reason inflation exists is simple. Money is a claim on goods and services. If more money is created, but the amount of goods and services stays the same, those claims become diluted. Imagine a game of musical chairs where more players keep entering the room, but no new chairs are added. Everyone starts competing harder for the same limited supply. Prices rise not because businesses are greedy, but because demand has increased relative to supply. This is basic economics, but the scale at which it happens in modern systems makes it far more dangerous. Historically, inflation used to be limited by physical constraints. When money was backed by gold or silver, governments could not easily create new currency without acquiring more metal. This acted as a natural brake on excess money creation. Once money became fully digital and debt-based, those constraints disappeared. Today, trillions of dollars can be created with a few keystrokes. The limiting factor is no longer physical scarcity, but confidence and control. Inflation does not affect everyone equally. This is one of the most important and least discussed aspects of the system. When new money enters the economy, it does not spread evenly. It enters through specific channels first. Governments spend it, banks lend it, corporations receive it, asset markets absorb it. This means the people closest to the source of new money benefit the most. They buy assets early, before prices rise. By the time the money reaches everyday workers through wages, prices have already gone up. This phenomenon is known as the Cantillon effect, and it explains why wealth inequality grows during periods of heavy money creation. This is why asset prices like stocks, real estate, and cryptocurrencies tend to explode during periods of loose monetary policy. The new money flows into financial markets first, bidding up prices. Meanwhile, wages lag behind. A house that cost $200,000 a decade ago now costs $500,000, not because it became better, but because the money used to buy it became less valuable. To the person who already owned assets, inflation feels like growth. To the person trying to catch up, it feels like an impossible race. Governments often argue that moderate inflation is necessary. They claim it encourages spending, prevents hoarding, and keeps the economy moving. And to a degree, they are right. A small amount of inflation can grease the wheels of commerce. But when inflation accelerates beyond productivity growth, it stops being a tool and starts becoming a tax. And unlike income tax, inflation is not voted on. It is not debated in Congress. It quietly extracts value from savings, wages, and fixed incomes without ever appearing on a bill. This is why people who save money in cash lose over time. If inflation runs at 3% and your savings earn 1%, you are losing purchasing power every year. Over decades, this erosion becomes devastating. Retirement savings shrink in real terms. Pensions struggle to keep up. Entire generations feel like they are running faster just to stay in place. Inflation punishes caution and rewards leverage, encouraging people to take on debt just to avoid falling behind. The cruel irony is that inflation is often caused by attempts to fix economic pain. Governments print money to stimulate growth, bail out failing systems, or respond to crises. In the short term, this can prevent collapse, but in the long term, it shifts the burden onto ordinary people. The economy survives, but the cost of survival is paid through higher prices, weaker savings, and growing dependence on debt. This is why inflation is not an accident of the system. It is a feature of it. A debt-based monetary system requires growth, and growth requires money creation. But when money creation outpaces real production, inflation becomes unavoidable. The system can delay the consequences, manage the symptoms, and smooth the edges, but it cannot escape the underlying trade-off. By the time you understand inflation, debt stops looking like a personal failure and starts looking like a structural trap. In a world where money constantly loses value, refusing to borrow does not keep you safe. It slowly pushes you backward. This is the part of the system most people feel, but rarely articulate. Debt is no longer just a choice. In earlier economic systems, debt was dangerous because money held its value. If you borrow gold or silver, you had to pay back something that did not inflate away. That made lenders cautious and borrowers disciplined. Today, the incentives are reversed. Inflation quietly rewards borrowers and punishes savers. If prices rise faster than wages, the only way to maintain your standard of living is to either earn more money or borrow against the future. Mortgages, student loans, auto loans, credit cards, buy now pay later plans, medical debt, even subscription financing. The system is designed so that the cost of living rises faster than cash savings. Housing prices outpace wages, education costs explode, healthcare becomes more expensive every year. At the same time, holding cash guarantees loss through inflation. Debt becomes the bridge between stagnant income and rising prices. When they create money through loans, they are not just responding to demand, they are shaping behavior. Lending expands purchasing power today in exchange for claims on future income. This pulls spending forward and keeps the economy moving. Without debt, large parts of modern economic growth would stall. This creates a psychological shift as well. Debt becomes normalized. People plan their lives around monthly payments. Instead of ownership, cars are leased. Homes are mortgaged for decades. Education is financed before income even exists. The system stops asking whether something is affordable and instead asks whether the payment fits into the monthly budget. The danger is that debt locks people into vulnerability. When income is stable, debt feels manageable. When income falters, debt becomes suffocating. Economic shocks hit borrowers harder than savers. Yet inflation quietly forces people away from saving. You are encouraged to borrow because holding cash is punished. But borrowing makes you fragile when conditions change. National debt is not treated as a crisis so long as it can be rolled over. Old debt is paid with new debt. As long as economic growth and confidence persist, the system holds together. But just like households, governments become addicted to borrowing. Cutting spending becomes politically impossible. Raising taxes becomes unpopular. Debt fills the gap. This is why debt crises are so destabilizing. When confidence breaks, lenders demand higher interest. Higher interest increases the cost of servicing debt. Governments respond by printing more money or borrowing more, which fuels inflation or further erodes trust. The system spirals not because debt exists. Debt feels like the only way to access housing, education, or opportunity. One medical emergency, one job loss, one economic downturn can undo years of careful planning. Debt also reshapes social behavior. People delay families, they delay risk-taking, they delay entrepreneurship. They prioritize stable income over meaningful work because missing payments is not an option. This makes the economy look productive on paper while quietly draining flexibility and resilience from everyday life. The system does not collapse because people are irresponsible. It persists because people adapt. They borrow, they refinance, they restructure, they survive. But survival is not the same as prosperity. And when an entire society is built on rolling debt, forward, once debt becomes the engine of the economy, someone has to regulate the speed. That role belongs to central banks. These institutions are often described as neutral referees, quietly adjusting interest rates and monitoring inflation. In reality, central banks are the control room of the modern financial system. They do not simply respond to economic conditions. They actively shape them. At the most basic level, a central bank controls the price of money. Interest rates determine how expensive it is to borrow and how attractive it is to save. When rates are low, borrowing explodes. Businesses expand, consumers spend, asset prices rise, and debt grows rapidly. When rates are high, borrowing slows. spending contracts, asset prices fall, and weak participants are exposed. This lever alone gives central banks extraordinary influence over every part of economic life. But interest rates are only the surface. Behind them sits liquidity, the availability of money itself. During calm periods, central banks operate quietly, nudging rates up or down and letting markets function. During crises, they step fully into the spotlight. They inject massive amounts of money into the system, buying government bonds, corporate debt, and sometimes even equities. This money does not come from savings or taxes. It is created digitally, expanding balance sheets in ways that would have been unthinkable just decades ago. These interventions are often justified as necessary to prevent collapse, and in many cases, they are. When financial systems seize up, confidence evaporates quickly. Banks stop lending. Businesses cannot roll over debt. Paychecks fail. Central banks step in to keep the system alive. But every rescue has consequences. Each time new money is created to stabilize markets, it reshapes incentives and expectations. Markets begin to anticipate intervention. Investors take greater risks, believing central banks will step in if things go wrong. This is known as moral hazard, and it quietly changes behavior across the economy. Risk is no longer priced purely by markets. It is priced with an assumption of protection. Over time, this inflates asset bubbles and deepens inequality, as those closest to financial markets benefit first from new money. Central banks also face an impossible balancing act. If they keep rates too low for too long, inflation accelerates and purchasing power erodes. If they raise rates too quickly, debt-heavy economies buckle under the pressure. Governments struggle to service debt. Businesses fail. Unemployment rises. Every decision creates winners and losers, and the costs are rarely distributed evenly. This is why inflation is such a sensitive issue. Inflation is not just rising prices. It is a silent tax that hits hardest on those who hold cash and earn fixed incomes. Meanwhile, asset holders often see their wealth rise as prices inflate. Central banks are acutely aware of this dynamic, yet they are constrained by the structure of the system. Once debt levels reach a certain point, aggressively fighting inflation becomes politically and economically painful. Another layer of power comes from coordination. Central banks do not act alone. They communicate, align policies, and support one another during crises. Swap lines allow dollars to flow globally. Emergency measures ripple across borders. This creates a tightly interconnected financial world where shocks in one region quickly spread to others, but also where rescue efforts reinforce existing hierarchies. Despite their influence, central banks operate at a distance from democratic accountability. Their decisions affect mortgages, rents, wages, pensions, and government budgets, yet they are often insulated from direct political pressure. This insulation is meant to protect stability, but it also concentrates enormous authority in the hands of a few decision-makers. For everyday people, the effects are felt indirectly. When interest rates rise, borrowing becomes harder. When they fall, prices inflate faster. When liquidity floods markets, assets surge beyond reach. When liquidity dries up, jobs disappear. Central banks do not target individuals, but their policies shape the environment in which individuals must survive. Understanding central banks is key to understanding why the system feels both powerful and fragile. It can generate astonishing growth and innovation, yet it depends on constant management. It cannot simply be left alone. It must be guided, adjusted, and occasionally rescued. When a financial system relies on debt to function, debt eventually stops being a tool and becomes the foundation. At that point, the economy no longer asks whether borrowing is productive or sustainable. It asks only whether borrowing can continue. This is the stage most advanced economies now occupy, and it explains why the system feels increasingly fragile even during periods of apparent growth. Over time, debt compounds faster than real productivity. New money enters the economy through loans, but the interest attached to those loans demands future growth that may not materialize. This creates a structural imbalance. More value must be produced tomorrow simply to service obligations created today. When productivity slows, the system compensates by creating more debt, pushing the burden further into the future. This is how entire economies become locked into a cycle of refinancing. Rather than repayment, governments issue new bonds to pay interest on old ones. Corporations roll over debt instead of paying it down. Households refinance mortgages and student loans rather than escaping them. The system survives not because debts are resolved, but because they are continuously extended. As this cycle deepens, growth becomes increasingly dependent on financial expansion rather than real output. Asset prices rise faster than wages. Credit flows toward speculation instead of production. Housing, stocks, and financial instruments absorb capital while infrastructure, education, and long-term investment lag behind. On paper, wealth increases. In lived reality, affordability declines. This dynamic reshapes society. Younger generations enter an economy already saturated with debt. They face higher prices, higher asset valuations, and fewer opportunities to accumulate wealth without borrowing. Debt becomes the entry fee to adulthood rather than a temporary bridge. The promise of future prosperity is replaced by the obligation of future payments. At the same time, political systems adjust to accommodate this reality. Governments become reluctant to allow recessions to cleanse excesses, because downturns threaten debt servicing. Economic slowdowns are treated as emergencies rather than natural corrections. Intervention becomes routine. What was once extraordinary becomes expected. This is why crises now feel repetitive rather than shocking. Financial stress builds quietly beneath the surface until something breaks. Central banks intervene, markets stabilize, debt increases, the cycle resumes larger than before. Each rescue reduces short-term pain but increases long-term dependence. Inflation emerges as the pressure valve in the system. When debts cannot be repaid through growth alone, they are eroded through reduced purchasing power. Prices rise, savings lose value, wages lag behind cost. Inflation does not eliminate debt, but it redistributes its burden, often away from borrowers and towards savers and wage earners. This process is rarely framed honestly. Inflation is blamed on supply chains, geopolitics, or temporary shocks. While these factors matter, they obscure the deeper cause: too much debt chasing a few productive opportunities. Inflation becomes the system's way of avoiding explicit defaults. Eventually, confidence becomes the most important asset of all. As long as people believe debts will be honored, currencies retain value, and institutions maintain legitimacy, the system continues. When confidence erodes, everything accelerates. Interest rates spike, capital flees, intervention intensifies, stability gives way to volatility. History shows that systems like this do not collapse gradually. They hold together longer than expected, then shift suddenly. What appears stable becomes unstable almost overnight. The triggers vary, but the underlying mechanics remain consistent. The critical insight is this: the system is not broken. It is functioning exactly as designed. It prioritizes continuity over resolution, expansion over balance, and stability today over sustainability tomorrow. Understanding this does not provide easy answers, but it does offer clarity. For people living inside the system, the effects are subtle at first and then impossible to ignore. The rules of money no longer reward patience in the way they once did. Saving cash feels like running uphill on ice. Even when you do everything right, you're purchasing. Power slowly leaks away. This is not a personal failure. It is the predictable outcome of a system designed to expand through debt, rather than preserve value through restraint. In earlier monetary systems, money was scarce by nature. Saving delayed consumption but preserved future options. Today, money is abundant but conditional. It exists primarily as a liability on someone else's balance sheet. That changes how individuals are forced to behave. Instead of asking how to protect money, people are pushed to ask how to keep money moving fast enough to stay ahead of inflation. This is why modern financial advice feels so counterintuitive. People are told to invest aggressively, take on good debt, leverage assets, and avoid holding cash. These strategies are not inherently reckless, but they are defensive adaptations to a system that punishes inactivity. Standing still becomes riskier than moving forward. Debt, in this environment, becomes normalized. Mortgages stretch longer. Student loans last decades. Credit cards bridge gaps that wages no longer cover. Borrowing is framed not as desperation, but as participation. Without it, access to housing, education, and even stability becomes limited. At the same time, risk is unevenly distributed. Those closest to the source of money creation, banks, large institutions, and asset owners, benefit first from new liquidity. Prices of assets rise before wages do. By the time money reaches workers, the cost of living has already adjusted upward. This is how inequality quietly widens without a single law being passed. The psychological effect is just as powerful as the financial one. People begin to feel like they are always behind, no matter how hard they work. Milestones that once marked adulthood, home ownership, financial independence, long-term security, feel delayed or unreachable. This breeds frustration, anxiety, and disengagement, especially among younger generations who entered adulthood after repeated crises. Importantly, this system also reshapes political narratives. Economic outcomes are framed as moral choices rather than structural ones. Individuals are told to budget better, hustle harder, or invest smarter, while systemic forces quietly narrow the range of viable outcomes. Responsibility is individualized. even as control becomes centralized. Yet, despite these pressures, people adapt. New forms of financial literacy emerge. Individuals learn to think in terms of cash flow instead of savings, assets instead of wages, and optionality instead of permanence. Side incomes, flexible careers, and digital tools become survival strategies rather than luxuries. This does not mean the system is fair. It means humans are resilient, but resilience has limits. When too many people are forced into constant optimization just to maintain stability, trust begins to erode. Faith in institutions weakens. Long-term planning gives way to short-term survival thinking. This is where financial systems intersect with social stability. Money is not just a medium of exchange. It is a coordination tool. When people lose confidence in it, cooperation frays. Cynicism replaces optimism. Risk-taking becomes either reckless or non-existent. Understanding this context is essential because it reframes the question. The issue is not whether individuals are making the right choices. The issue is whether the system allows good choices to compound into security over time. When a debt-based monetary system reaches maturity, the warning signs do not arrive all at once. They surface gradually, often disguised as unrelated problems. Rising living costs feel like bad luck. Growing inequality feels like a cultural failure. Political polarization feels social rather than economic. But beneath all of it is the same structural tension. A system that requires constant expansion running into a world with finite growth. Historically, monetary systems fail in only a handful of ways. They either reform themselves, reset through crisis, or collapse under their own contradictions. What determines the outcome is not ideology, but timing. Reform requires trust, coordination, and sacrifice before collapse forces those changes violently. In a debt-driven economy, growth is not optional. New money must enter the system to service old obligations. If growth slows, defaults rise. If defaults rise, confidence breaks. To prevent this, central banks intervene by lowering interest rates, expanding balance sheets, and encouraging more borrowing. These actions stabilize the system in the short term, but they also pull future demand into the present. Over time, this creates diminishing returns. Each intervention must be larger than the last to produce the same effect. This is why modern crises feel repetitive. Asset bubbles inflate and deflate. Bailouts become normalized. Emergency policies quietly turn permanent. What once would have been unthinkable becomes routine, not because leaders are reckless, but because alternatives shrink. At this stage, the system becomes increasingly dependent on perception. Money works because people believe it will continue to work. Banks function because depositors trust withdrawals will be honored. Governments borrow because investors trust repayment will come. When confidence holds, the system persists. When confidence cracks, outcomes accelerate quickly. The most dangerous moment is not collapse, but denial. When warning signs are dismissed as temporary, when structural issues are framed as partisan talking points, meaningful reform becomes politically impossible. By the time consensus forms, options are limited. Yet collapse is not inevitable. History shows that systems can evolve. Gold-backed money gave way to paper. Paper gave way to digital credit. Each transition was chaotic, but also adaptive. The question is not whether change will happen, but whether it will be managed or forced. In the modern era, responses take new forms. Some nations experiment with tighter regulation. Others embrace financial repression, keeping interest rates artificially low to manage debt burdens. New technologies introduce alternative stores of value, while governments explore digital currencies that increase control and efficiency at the same time. For individuals, this environment demands a shift in mindset. Stability no longer comes from static strategies. It comes from understanding incentives, remaining flexible, and recognizing that money is a system, not a promise. Financial security becomes less about accumulation and more about adaptability. The deeper truth is this: money is not just a tool we use. It is a reflection of collective agreement. When societies agree on what is value, systems hold. When that agreement fractures, systems change. We are not at the end of money, nor at the end of debt. We are at a transition point. The old assumptions no longer fully apply, but the new rules are still being written. History suggests that those who understand the structure early are not the ones who panic. When it shifts, the real question, then, is not whether the system will change, but who will be prepared when it does.